Hey everyone, it's Ed Kime from over at Quantcha, and welcome back to another day of the Quantcha Challenge. We're kicking off a little early today due to some scheduling we've got going on internally, but it's a pretty exciting day out on the market. As always, we invite you to check out our unlimited commission-free stock and option trading offer, where you get everything we offer in the Quantcha platform, all of our web tools, all the stuff we're going to show here today, and unlimited commission-free trading for stock and options for just $99 a month through your linked Tradier account. So, without further ado, let's step in and take a look at where we are with the portfolio. Today has been a pretty bad day for us across the board. We're bullish on Carnival, it's down. We're bearish on Micron, but it's not far down enough to make up for some pain we took on last week. Nvidia continues to just completely fall through the cracks. We literally opened this trade up on end of day Friday when it was at 160, and it's now 130. And then Exxon is something we're bearish on, and it's up. Fortunately, we're still in the realm of profit for our trade here. That we've got a bearish spread that we were about break even on, a little bit on the profit side maybe, and then we've got a calendar trade for a long straddle here that we're hoping it moves away from the strikes, because right now just hanging out here does not it doesn't help us in the least. But I'm not going to focus on that too much today. We're not going to spend much time on the portfolio. There's one trade that I saw just kind of browsing through the usual screeners and stuff that I take a look at, that I want to zero in on, and it is in our earnings one-day calendar straddle search. And this is really just it's not really a calendar straddle search, just the earnings one-day search, like earnings effectively being announced tomorrow. So we'll save that, so it's better named. And this screener is pretty simple. It's just one trading day until earnings, meaning that we have to trade today and then earnings will happen before the market opens tomorrow. And we're looking for at least good liquidity and stocks with weekly options. Now, what we like to do is we'll take the earnings crush rate and we're going to sort by that, and we're going to sort by it increasing. So we'll see some of these stocks here. For example, eBay. If we take a look at eBay, their earnings crush rate right now is 347 basis points, which is okay, not too exciting. Royal Caribbean's another one. I was tempted to go with them as a hedge against Carnival, although I like them a lot too. 612, that's much better. But the trade that I'm really excited about is to get in on AMD, because AMD's weekly their weekly options for this week after earnings are just through the roof, and this earnings richness is substantial, basically over 14 percentage points, which means we should be able to construct a calendar trade where we sell this week's volatility against next week's volatility, and then profit off the difference once the time value is settled on either side. Now, I got some really good feedback on the calendar trade we did with Granger, and we did a calendar straddle. It's easy to understand, it's easy to construct, and we made great profit on it. However, the problem with the calendar straddle is that it sort of like profits in the middle, just like a butterfly or a condor. Like, it's very range bound in a specific. It kind of comes to a point where the closer those strikes are together, or in the case of the straddle, they're the same strikes. So what we're going to do is we're going to come out here to this first earnings, the first option series after earnings, and we're going to ask for a neutral view. And we don't really care too much about what trades it comes back with, because we care about this price range. Our presets use the volatility to determine what basically what we want to trade. So if we say very bearish, then it's going to give us a price model that shows a 2% volatility drop, which takes the implied volatility, turns it into a periodic volatility between now and the end of the expiration, and then uses that as a standard deviation and says two of those down. So in this case, this price drop of 14% down drop in the underlying represents that it's about a 7% drop would be if you took this implied volatility and you made it into a periodic volatility for this week. So there's sort of two interesting things that are going on there. The first one that tells you is that a lot of people will check an implied move based on a straddle at the money and see, if you were selling that straddle, what would it be to break even, or if you were, buying it, what would it be to break even, and determine that is the size of your implied move for the underlying stock. Another way to do it is to take the implied volatility and use this model where we say plus or minus what that indicates. In this case, it's modeling a 14% drop and a 16% rise as being those plus or minus one volatility markers. So we want to keep this number in mind. This let's say 1650 and 2250. Now, we'd like to construct I'm going to use a calendar strangle trade here, which is we're going to short a strangle on this week and long a strangle for next week. And we're going to try to optimize our profit around these points. Instead of having that profitable spike in the middle where it'll never end up after earnings because nobody ever stays exactly where they are, we will, we'll basically try to optimize around those 2 points so we can get the most of our return in the event that it hits either that, kind of lands plus or minus one volatility. Now, of course, it's just the opinion that I'm spreading here that's the view I have on how this could move. But we can see that the forward price of the stock right now for this week, which is the break even for a synthetic long, is right at the money right now. And so that's kind of a good indication that we've got a pretty liquid set of options, the skews are in line, and that there isn't really heavy sentiment to be drawn directly from those at the money options about direction. So, even though there's a lot of concern about AMD right now, understandably with everything going on in, with the trade war and all that other stuff, we can hopefully profit off the volatility of the people who are looking to buy this week's options. So the numbers we were talking about were 1650 and 22 and a half earlier, if I recall. Let me just double check that I got that right. So it was about 1650, about 2250. So if we come to the options, we're going to manually construct a trade here just to find exactly what we want, and we're going to say we want to sell this call here at 2250. So we're going to say a naked call. And we're also going to add in, we're going to customize the strategy so that we can add an option leg where we're going to sell the put at 1650. So we'll just find that in here. And so if we apply that, we get our P&L for this particular trade, which we're not going to go naked on. But as you can see, plus or minus one vol, this would show a profit of about 21% if it stayed within that range, which is great. So we're going to send that to our book for AMD tied to our portfolio account. Now, I don't like trading these things naked, and also there's a very good chance that it's going to break through this plus or minus one volatility mark. So if it's going to make that move, we obviously want to hedge against it. So we're just going to go back to the view we were looking at, which is the short straddle, and I'm going to invert the strategy. So now we have a long straddle. This is just buying the options that we were looking at. And it's not so much the options we care about, it's the strikes, because we're going to slide this trade forward 1 week to the 8th. Now we're looking at this same exact trade. I'll hide this. We're looking at the same exact trade, only we're taking the other side of it for a week out. And so if we throw this at the book, we're now going to have a position where we've got 2 shorts for this week and 2 longs for next week. So short and short at 16 and a half and 22 and a half, and then long. And then the idea is that we're going to be covered so that we're zeroing out on our we're trying to kind of negate our delta here. As you can see, the delta is a little over 1, gamma is almost 0. And those will be impacted a little bit as the stock moves after the earnings announcement. But the point is, we're trying to capitalize on the drop in short week volatility versus the long week. And at this point, this 23 tells you that what this means, since we're dealing with one contract for each year, that's saying that we are paying 23 cents a share in time value to open this trade. So that's kind of our key number here from a market perspective, is to say, do we have confidence right now that there would be more than 23 cents in time value per share available for this trade after the earnings clears up? So after the short week gets crushed, do we think that we can get 23 cents a share of remaining time value in the options we have, plus whatever intrinsic value or anything else that comes in? The intrinsic value for the positions are going to offset. Now, this might be a little bit aggressive because, as you can see, right now without the earnings, this 16 and a half put, it's selling at 30 cents, which means that it's going to lose more than 7 cents if it were to stay. But our hope here is that what we see is that there's enough movement upwards where that this 22 and a half call basically becomes at the money, because if it is at the money, then it should have much more than the at. So as an example, like if we step out, we just took a look at this week's at the money options. Now this is a bad example because of the fact that obviously there's a ton of earnings volatility priced into there. But if we went to that point, that 1950 mark, I mean, this is at the money, so this is virtually all time value, that $1.15. And so so being there, what we're seeing is there's $1.15 in time value for at the money options, and our hope is that for the book that we're working through here, that we can get to be that one of these options ends up being at the money for next week. And so the sort of the roundabout way to get into it is that in the event that we're able to kind of land somewhere in this neighborhood, we should be able to see enough time value remaining on the longs that it offsets the cost that we would get for the shorts. So that being said, I mean we are a bit wide here. We're looking at this, and I'm just doing a quick last second sanity check. We are modeling in here. Another thing that's important to note is that the pricing that's going on here is we're actually taking, because this is using this Friday as the expiration date. So that's going to tell you that when we come in here to trade this, we're basically taking the positions we have, and there's volatility that's really high on all these options. And then as we approach this expiration, the volatility on the short options approaches zero because there's going to be no time value left and they're going to be purely worth their intrinsic value. There will be a bit of a liquidity cost to close them out, but for example, if the stock goes up to let's say 24 overnight, it has a nice, in this case, what would be jump of 4 would be a 20% jump. If it makes that jump, then the puts that we have short for this week will pretty much go to zero. And then the puts that we have for next week will have some level of time value remaining. The calls, though, this call will have some amount of intrinsic value and a little bit of time value, and then we're hoping that we can get a lot more there. But the important thing is the volatility that we model here. We're not using the same volatility they have now. We know that the volatility for these February 8th options is definitely going to drop after the earnings is cleared up. And so there is some modeling going on under the covers that uses a variety of techniques to figure out what should a reasonable expectation for this option, for this expiration at this strike, or rather at this moneyness, be worth at that point in the future. So without further ado getting into it, we have well, actually a little bit more risk analysis here. We do have two other things to worry about, right? One is a huge surge. So in other words, if we see a 40% spike in the value of AMD, that would be a risk here. Of course, I think that's fairly unlikely to be seen. Right now, the bigger concern would be if there's a major drop. But as we can see from the stock itself, if we look over the past month, it hasn't really. I mean, it was a bit higher earlier this week, or rather last week, and it's kind of been on its way down. I don't know that. Was it 22 was the high on Friday. That was a high for, really since December. And even then, December, it wasn't trading that. So what I'm going to do here is I don't know. I don't know if we can necessarily expect it to even come back this high. If we go back 6 months, yeah, it was substantially higher. I don't know that we expect it to go back over 30 between now and tomorrow. So we have that upside. My bigger concern right now looking at this P&L is I feel like there's a bigger possibility for it to drop significantly. Like, I don't know if it goes to 15 or even below 15, but if it comes down in this range, we are at risk of losing money. And so I'd be more inclined to try to take some of the profit potential from this side and slide it over here. And the way we can do that is we can actually push the options down. So we could take our 22.5 and we could roll them. Now the thing to be really careful about here, and this is a pretty legitimate risk, is we don't have a lot of room between these strikes and these strikes. So when we buy in the value here, if we're going to pay 30 cents and we're going to sell this for 18 cents, we're paying 12 cents for this calendar spread. And in order to get that calendar spread, what we're kind of hoping for, and I've said this a bunch of times, but at the end of this is we're hoping that this option is worth at least 12 cents more than this option. So there is a bit of risk by having these strikes out so wide, but that is also the nature of us expecting there to be that big movement. The third scenario, besides a huge movement downward, huge movement upward, is just it hangs out in the middle. And if it just sets up shop right here, right now it shows us as actually eking out a bit of a gain. But if we think about it, what we're really saying at that point is at the money is here. Our option strikes are 16.5. I feel like if it were to end tomorrow without any movement at 1950, that the 1650 puts for this week would indicate that it would be expecting a drop of about 15% that would be unlikely, right? I mean, it's pretty unlikely that would happen. So those would probably crush to zero, as well as the calls on the same effect on the other side. But my bigger concern is more that when these guys drop down, we just don't know how much the value is going to be retained in our long puts. So I'm just kind of thinking out loud here with some of the strategy adjustments we could make. If we brought these strikes in, we would see more potential in the middle, but we'd have less protection on the outside. At the same time, if we were to move these strikes further out, we would have a higher probability of being able to turn a profit, but we'd have more risk in the middle of potentially getting hurt by liquidity. So, um, yeah, I mean, it is what it is. Right now, the pricing might have moved around a little bit. Let's send it to a ticket to just get an idea. 20 cents is our net debit. That's probably something we'll be able to do. I don't know how hard these are going to crush down tomorrow, but if we try to get into 20, we're obviously going to trade a bit more of these. 20 is literally just a $20 investment. So if we went all the way out and we just did a lot for each, and we were able to get in at 20, then I think that's 2 grand. I mean, that's a bit more of an investment. I mean, that represents about that's 8% of our current portfolio, and I don't know that I want to necessarily put 8% up against this particular trade. I do feel pretty confident that we're going to be able to turn a profit on this. I think the edge is really in our favor, but we're being a little bit not I wouldn't necessarily say greedy, but we are taking a bit of a risk here. Maybe what we'll do is we'll bring it down. We'll go halfway. We'll just go to 50, and then nobody wants to lose. Nobody would want to absorb a loss of $1,000 on a portfolio like this. But again, I don't I mean we're not putting the entire thing at risk necessarily. So with any luck we'll be able to see a bit of a profit. But I would also anticipate we will get a return on this of something. We won't lose everything overnight. There's no way that could happen. Or So we'll let this trade sit for a second. We've got this Exxon trade. This one was kind of some wishful thinking. We had hoped that the straddle would be able to close at 3. If this thing just hangs out at 71.50, we're gonna be pretty sunk. The good news is we had it for a few days now, including holding it over a weekend. And even though it's just planted right at the money, um, I think we entered it 230, so we're literally down 10% on the trade. So we've held uh, an at the money straddle for some time now, and have been able to kind of hang out and make it through there. But uh, I don't want to really chase this trade, but we could see the net debits coming down. It's actually getting a little cheaper as we see that. The other issue we face here is that when we go to open trades like this, the option positions we're looking at, one market maker has to fill this whole thing. So somebody has to come along and be willing to take on the risk. And as we saw with Granger, when we tried to get out of a calendar straddle, we were really unable to get any fair pricing on it at all. I mean, the pricing was crazy, and that was really probably more a function of the fact that that one trade. There was very little upside for somebody who was going to take the other side of that entire trade when we were trying to close it out for our profit. So we ended up having to leg out and close our shorts one by one, close our longs one by one. We could probably eke in slightly better pricing here. I mean, maybe we could guarantee ourselves to get to this 20 cents if we came in leg by leg. But I don't know, because you can see we've got penny widths on these. So at some point, I mean, this is 2 cents here. That's our widest spread. At some point, somebody will have to cross the line and say they're willing to give us a slightly better deal on it. But I don't know that's going to happen. Um, this is the part of the of the trading that I know gets pretty boring. So the other thing I wanted to do is, somebody had asked about on the last time around, what happens if instead of our calendar straddle, where we kind of identified an opportunity similar to how we did today and set up a trade with this P&L. What if we had great results, but what the question was, what if we just did a calendar call or a put spread? Calendar call, calendar put, like opening one side or the other. And we had this is an important number here, this 108. So we had 108% for gain for the trade overall. But they said, wouldn't it be more efficient or more effective or lower risk if we just did the put side or the call side? So let's take a look at the contributions for this particular trade. I broke it down and said, okay, here's what would happen for the call side. The front week call we sold for 1480, and the back we bought for 1577. The net cost us 97 cents to get in the position. After they closed, we had a substantial change, and our net return was 98 cents, and so we were able to eke out a bit of a gain from that. On the other hand, the returns we had here were so we were able to get a 101% return for the first one. Sorry, and they were 7% out of the money when we closed because the stock moved down. On the put side, it was the opposite, right? They were 7% in the money for the calendar spread for their strikes, and they kind of had the opposite effect. But at the same time, we were able to get 114%. So in this particular case, yeah, if we had just known to go on the put spread, we got the return and it went to our favor. But this sort of spread out the benefit. I mean, we probably wouldn't have seen 114 if it went the other way. We would have been much more likely to have we would have gotten a lower return. So this way, I feel like we kind of spread it out, did a better job of getting an a less risky return. And also, if there had been a bigger movement either direction, one side would have definitely been more profitable than the other. And there's of course the point where it moves so far that neither side's profitable, but we wanted to minimize the risk. And in this case, the calendar was a better trade. At least that's my opinion for that. I noticed we got this kind of hanging out here, and I had hoped it would fill by now. It hasn't. Let's take a quick look at what it would take if we went and we did a calendar spread, calendar straddle for this case. So I'm going to go ahead and select this week's options. It's trading right around 1950, so we're going to sell a straddle. And we're going to send this to our paper book. We're just going to send it to a different book to model against. This way it doesn't overlap with the options that we're looking at for this week. So with the calendar straddle, I moved back to the trade analysis here. We'll move forward a week, and then we will invert the position to give us the strategy that counters that. Send that to our paper book. And so this would be our P&L for this week. And so this is the calendar straddle again, like we did for Granger. The only thing I didn't like here was that the movement for this guy was only about 18%. And I'm actually starting to have my doubts about the other trade we have on now, because I realized that the time value that we're looking at, there's not as much time value as I would like in the current straddle. The risk when you think about having to close out, we'll probably end up having a leg out of that position tomorrow in the event that we see what we like. Right now, if we open up this calendar straddle, we would have to get less than an 18% move up or less than a 14% move down to break even. So we see we're not even covered at the -1 strike there. And then that's how we can start to play around with these options and to move that stuff around. I'm going to jump back into where we were with with our orders just to see if it hasn't filled yet. I think I might just go ahead and cancel it out and then open a different straddle, or rather a different strangle. I'm not going to keep everybody around for that, but we were asking for 21 cents. I thought it's pretty reasonable, but it's not moving in. What we'll do is we'll try one thing. I'll notch it up to 22 cents, see if we can get that to be sweet enough to close the deal. And if not, then I will spend the rest of my own time worrying about trying to notch in, maybe leg in or do what I can to get this position open. But otherwise, I'll figure something out. We're definitely going to trade this calendar volatility going into tomorrow, and yeah, and then so definitely come on back tomorrow and we will review it and see how the trade turned out. We won't let this drag on any longer. If you have any questions or any feedback, of course, leave us a comment or hit us up at hello@quantcha.com. And as always, good luck and good hunting.